John Insight here. Critical market development unfolding right now. And if you're holding silver, if you're watching this market, what I'm about to show you explains everything that's been happening over the last 48 hours. The violent moves, the whipsaws, the confusion. It all makes sense when you see the full picture. Let me give you the current state. Silver just spiked to $91.31 this morning, up 8.08% on the day after crashing below $74 last Thursday. That's a $7 move in 24 hours. Gold rallied to $5,035, up 1.81%. The gold-silver ratio compressed to 55.1. And here's what nobody's connecting. This isn't just volatility. This is the paper market fighting against physical reality. And physical reality is winning. But before we dive into what's driving this, let me show you something critical that happened yesterday. About 73% of you watching right now aren't subscribed. If you want unfiltered real-time analysis backed by verified data, not hype, not moon predictions, not zero predictions, just what the data actually says, hit subscribe right now. This channel exists to cut through the noise and show you what's real. And if this adds value, drop John Insight in the comments. It helps me see what resonates and keeps this analysis grounded in what matters to you. All right, let's get into it. Yesterday, February 4th, U.S. Vice President J.D. Vance stood in front of 55 countries at the Critical Minerals Ministerial in Washington, D.C., and made an announcement that fundamentally changes the game for silver. The United States is establishing a price floor system for critical minerals. Silver is classified as a critical mineral. Let me read you what Vance said. We will establish reference prices for critical minerals at each stage of production. For members of the preferential zone, these reference prices will operate as a floor maintained through adjustable tariffs to uphold pricing integrity. This is not speculation. This is government policy. Reuters confirmed it. Bloomberg confirmed it. CNBC confirmed it. The U.S. is creating a preferential trade bloc with price floors for critical minerals, and silver is included. Now here's the question nobody's asking publicly, but everyone's thinking privately. What if the price floor is set above the current paper price? Price floors are designed to keep domestic production viable. If the floor is set at, say, $95 or $100, and the paper market is currently at $91, what happens? Paper would be forced to adjust upward to meet the floor. The government becomes the buyer of last resort at the floor price if market price falls below it. This is the Strategic Petroleum Reserve model applied to critical minerals. The implications are massive. Now, connect that to what China did on January 1st, 2026. China moved to a license-based export regime for refined silver. They didn't announce a blanket ban. What they did was effectively ban silver exports, unless the exporter is government approved and meets strict criteria. Here's the barrier. Exporters must produce at least 80 tons of silver annually and secure $30 million in credit lines. That excludes most small and mid-sized firms. Only 44 companies were approved to export silver in 2026-2027. Why does this matter? Because China controls 60 to 70% of global silver refining capacity. When you restrict who can export, you remove a massive portion of refined silver from open international markets. And here's the kicker. China is both a net exporter of refined silver and a net importer of silver ores and concentrates. In 2024, China exported $3.8 billion of refined silver while importing $1.46 billion, so net exporter on refined metal. But they imported $5.57 billion of silver ores and concentrates and exported only $3.69 million. What this tells you is China is the refining bottleneck for the world, and they just turned that bottleneck into a strategic lever. Tesla CEO Elon Musk responded to the restrictions on X, saying, "This is not good. Silver is needed in many industrial processes." He's right, but the policy is already in effect. Now let's talk about what's happening on the physical delivery side in New York. And this is where the paper market is starting to crack. 14.8 million ounces of silver delivery notices hit COMEX vaults in the first 4 days of February. Let that sink in. 14.8 million ounces. That's 2,955 contracts. At the close on January 30th, open interest in the February silver contract was just 1,231 contracts. Yet by Tuesday, February 4th, only 2 days later, 2,955 delivery notices had been issued. That's 2.4 times the entire open interest demanding physical delivery. New longs are entering the market and demanding immediate delivery of physical silver. They're not hedging. They're not speculating. They're taking metal and leaving. This is the second consecutive month of historically massive deliveries in a non-primary delivery month. Primary delivery months like March, May, July typically see high delivery activity. February is not a primary month. It usually sees minimal deliveries. But February just posted 14.8 million ounces in 4 days. Let me give you context. In January 2026, 33.45 million ounces were physically withdrawn for delivery in just 7 days. That was 26% of COMEX's registered inventory in a single week. The registered inventory available for delivery is being drained, fast. And here's the structural problem. The ratio of paper silver contracts to actual physical ounces of silver backing. Those contracts is 356 to 1. That's not a typo. For every physical ounce of silver backing the paper market, there are 356 paper promises. Let me give you context for what happened late January, because it explains the volatility we're seeing now. Silver spiked to around $120 per ounce on Thursday, January 29th. Then on Friday, January 30th, it crashed to roughly $78. A 35% intraday wipeout, the worst silver day since 1980. Multiple things happened simultaneously. CME raised margin requirements aggressively, London Metal Exchange had system issues, HSBC's trading systems went offline. JP Morgan closed a massive silver short position at the exact intraday bottom. Was this coordinated? I can't prove it. But the timing was perfect for anyone short silver and catastrophic for over-leveraged longs. What we know for certain is that forced liquidations hit the market, leverage got flushed, and after the flush, dip buyers stepped in hard. Since then, silver has recovered from $78 to $91 as I'm recording this. That's a 13-hour bounce in 5 days, and the structural drivers that push silver to $120 haven't changed, they've intensified. Now let me show you the pattern that's developing this week. Monday, silver rallied to $90 during Asian and European hours. Then during the New York session, massive selling hit. Dropped to $83, that's 8 to 9% down from $90. Tuesday, same pattern, silver rallied to $90. Then during New York session, sold off again. 2 days in a row, rejected at $90 during New York trading hours. Haven't found a daily close above $90 yet. The 150 EMA on the hourly chart sits at resistance around $96.97. We're currently at $91, so $6 to $7 below that level. Here's the pattern. Up all night on global physical demand. Down all day via derivative selling in New York. Physical buyers accumulating overnight. Paper sellers dumping during U.S. trading hours. This is manipulation visible in real time. The question is, does this pattern continue, or do we finally break through $90 and hold? Here's the part that explains why the bearish case is overwhelmed by structural reality. The one-year silver swap rate minus U.S. interest rates shows silver market imbalances larger than during the 2008 financial crisis and the 2011 silver mania. This is the highest structural stress in the silver market in modern history. Central banks are accumulating at record pace. For the past several years, central banks led by China, Russia, India, and Turkey have been buying gold at historic levels. They just topped 5,000 tons for the first time in history. This relentless central bank buying acts as a massive price-insensitive bid. They're not trying to scalp a few points. They're accumulating strategic reserves for the long term in ever larger numbers. And here's what Americans don't understand, the intense gold and silver buying happening around the rest of the world. Americans think because they're not buying, the rest of the world isn't buying. They will pay dearly for that ignorance. China's gold and silver demand is stable. Physical demand globally is not collapsing despite paper price volatility. Let me give you the risk context as of today, February 5th. U.S. stocks dumped yesterday. S&P down 0.95%, erasing about $580 billion in market value. NASDAQ down 2.4%, wiping out roughly $1 trillion. Russell 2000 down 2%, losing around $64 billion. Risk-off sentiment is spreading across all asset classes simultaneously. Nuclear talks between the U.S. and Iran scheduled for last Friday were canceled. Oil prices surged to $65 per barrel on the news. Geopolitical tensions escalating. China's 4 largest gold-backed ETFs posted negative $980 million in outflows on Tuesday, the biggest daily withdrawal on record. This is 2.5 times the previous record set in May 2025. The 2-day total is negative $1.3 billion. Sentiment in Chinese gold markets is seeing massive swings. MicroStrategy's Bitcoin position is now down over negative $2 billion as Bitcoin dropped below $73,000. Ethereum fell below $2,800 for the first time since May 2025. Everything is selling off, but silver is bouncing hard. Let's cut to the chase. 3 must-know takeaways. Number 1. U.S. Vice President Vance announced a price floor system for critical minerals, including silver, yesterday. This fundamentally changes market structure. Price floors are designed to keep domestic production viable. If the floor is set at or above current paper prices, paper will be forced to adjust upward. This is government policy responding to strategic necessity. The Strategic Petroleum Reserve model applied to critical minerals. The implications are enormous. Number 2, 14.8 million ounces of silver delivery notices in the first 4 days of February. That's 2,155 contracts versus 1,231 open interest at month end. 3 times the open interest demanding immediate physical delivery in a non-primary month. New longs entering and taking metal immediately. This is the second consecutive month of historically massive deliveries in non-primary months. Physical demand is relentless despite paper volatility. Number 3, pattern established. Rejected at $90 during New York session 2 days in a row. 8 to 9% reversals both times. Haven't found a daily close above $90 yet. 150 EMA on hourly chart resistance at 96.997s. Up all night on global physical demand. Down all day via derivative selling in New York. Risk-off sentiment spreading. Iran talks canceled. China ETF outflows record. But silver market imbalances larger than 2008 and 2011. Structural tension building. Here's the unresolved tension. Price floor system being established by U.S. government. 14.8 million ounces physical delivery in 4 days. Silver market imbalances at historic extremes, but can't break through $90 resistance. New York session selling pattern consistent. Risk-off spreading. Geopolitical tensions escalating. Does the $90 rejection pattern continue until the price floor mechanism is implemented, or do we break through based on physical demand, overwhelming paper supply? The government is responding to strategic reality. The paper market is responding to leverage and positioning. Which force wins short-term determines if we test lower or finally break $90 and head toward that 150 EMA resistance at 96.97. Do your own due diligence. Understand the risks. The $90 rejection pattern is real. 2 days in a row, 8 to 9% reversals during New York sessions. Risk-off sentiment is spreading. Iran tensions escalating. But the U.S. government is establishing a price floor system for critical minerals, including silver. 14.8 million ounces physical delivery in 4 days. Silver market imbalances at record extremes. The paper pattern and the structural policy developments are moving in opposite directions. Know which time frame you're trading. Invest with logic, not hype. Use your own brain. Don't follow anyone blindly. John Insight, out.